I think the absolute key thing to ensure that an investment does not turn out to be a value trap, whether you're in an exotic market or not, is that you never presume multiple expansion, and you remain open to the idea of multiple compression. Now, in the case of Kazakhstan, the banks that we've invested in trade at book and have around a 20% ROE. So the multiples are already very low. I think that multiple compression is very unlikely. But at any rate, we aren't buying into a company where we're focused on the stock market putting a higher value on it. We're really focused on the real economic earnings that it can generate, flowing through, and they are paying dividends today, and having a similar value on the business. And in the case of that bank that I mentioned that's listed in London, that trades at book and has a 20% ROE, I think the current earnings that it's generating are sustainable, and in certain circumstances could accelerate, but at any rate I think are sustainable. If I'm right about that, in a year, the business should be worth something like 20% more. Minus the few percent, the 3.5% or 4% dividend that it'll pay us. But if that's the case, and the stock doesn't appreciate, it'll get cheaper. I think that a problem that I think that the source of a lot of errors in investing have to do with hoping for multiple expansion. And the fact is, multiple expansion does come. And another source of error in investing is not holding something and seeing through the multiple expansion that will come. But if you're focused on that, if that's a part of your thesis working out, then that can disappoint you, and then you can tie up capital in as you call it, a value trap. If you buy something cheaply enough that's soundly capitalized, it shouldn't be. Hopefully, it won't be worse than a value trap. But a value trap, having capital tied up for years at subpar rates of return, is a horrible thing to happen to a person.